Imagine walking into a bank and depositing $100. Most people believe that money simply sits safely in the bank until they decide to withdraw it. It feels secure, stable, and untouched. But behind the scenes, something very different happens. That $100 doesn't just stay $100. Inside the modern financial system, it quietly multiplies. Not because someone invested it brilliantly, and not because a business suddenly created value. Instead, it multiplies through mechanisms built directly into the banking system itself. In fact, that same $100 can quietly support hundreds or even thousands of dollars circulating through the economy. The unsettling truth is that banks were never designed simply to store money. Over centuries, they discovered something far more powerful. They could create money from deposits. Two hidden multipliers slowly emerged inside the financial system, and today they shape nearly every part of the global economy. To understand how this works, we have to go back several centuries, long before modern banks existed. In the early days of trade, wealth was often stored in gold and silver. Carrying precious metals around was risky and inconvenient, so merchants began storing their gold with goldsmiths who had secure vaults. In return, the goldsmith gave the merchant a written receipt confirming the amount of gold stored. These receipts soon became convenient. Instead of withdrawing the gold every time they wanted to make a purchase, people simply traded the receipts themselves. The receipt effectively represented the gold. Over time, these receipts began functioning like money. But this is where something interesting happened. Goldsmiths noticed that most people rarely came back to withdraw all of their gold at once. Some would withdraw small portions occasionally, but the majority left their gold in storage for long periods of time. That observation changed banking forever. Goldsmiths realized they could lend out some of the gold while still keeping enough in the vault to satisfy normal withdrawals. This idea became the foundation of the first secret money multiplier known today as fractional reserve banking. Imagine a bank receives a deposit of $100. Instead of locking the entire $100 away, the bank might keep only a fraction of it in reserve, perhaps $10, while lending out the remaining $90 to a borrower. That borrower spends the $90, and eventually that money gets deposited into another bank account somewhere else. Now the second bank keeps a small reserve, perhaps 10%, and lends out the rest again. The $90 becomes $81 in a new loan. That $81 is deposited again, and another bank lends out roughly $72. The process repeats again and again. With every step, new deposits appear in the system. The original $100 slowly multiplies throughout the banking network until it may support nearly $1,000 circulating in the economy. No physical money was printed, and no gold was discovered. Yet the money supply expanded through lending. At first, this multiplier allowed economies to grow much faster than they could have under a strict gold system. Businesses gained access to loans, trade expanded, cities grew. But the system had a dangerous weakness. If everyone demanded their deposits back at the same time, the banks would not have enough money to pay them all. Most of the money existed as loans rather than cash in the vault. Throughout the 19th and early 20th centuries, this weakness caused repeated financial disasters known as bank runs. When rumors spread that a bank might fail, customers rushed to withdraw their money. But since most of the deposits had already been lent out, the bank could not meet the sudden demand. Panic spread quickly, and banks collapsed one after another. One of the most devastating examples occurred during the Great Depression in 1929, when thousands of banks failed and millions of people lost their savings. The financial system nearly collapsed entirely. Governments realized that the money multiplier was powerful but extremely fragile. To stabilize it, they created central banks. In the United States, this institution became the Federal Reserve. Established in 1913, other countries created similar central banks around the world. These institutions were designed to act as lenders of last resort. If commercial banks ran out of cash during a crisis, the central bank could provide emergency funds to keep the system operating. But over time, central banks discovered they possessed another extraordinary ability. They could create new money directly by expanding the reserves held by banks. This became the second hidden money multiplier. Unlike traditional money printing, modern central bank money creation is largely digital. When central banks inject money into the financial system, often through policies like quantitative easing, they increase the reserves banks hold. With larger reserves available, banks are able to issue more loans. And once those loans begin circulating through the system, the first multiplier activates again through fractional banking. For example, if a central bank injects $1 billion into the banking system, that new reserve base can potentially support several $billion in new loans. In effect, the central bank's actions multiply the banking system's ability to create money. Together, these two mechanisms transform the global economy. The first multiplier allows banks to expand money through lending. The second multiplier allows central banks to expand the banking system's capacity to lend. Over time, this structure fueled enormous economic growth. Mortgages allowed millions of families to buy homes, businesses gained access to capital, governments financed infrastructure and development. But there was also a side effect. Debt expanded faster than ever before. Today, the global financial system runs almost entirely on this structure of expanding credit. Worldwide debt has now exceeded $300 trillion, more than 3 times the size of the entire global economy. Every mortgage, every student loan, every government bond exists within this network of money multiplication. But this raises an uncomfortable question.
Yes.
If money is created when loans are issued, and those loans must eventually be repaid with interest, where does the extra money come from to pay the interest? The system requires continuous new borrowing to keep functioning. As new loans are issued, new money enters the system, allowing old debts to be repaid. Without this ongoing expansion, the system begins to slow. History shows this pattern repeating again and again. Credit expands, asset prices rise, and the economy grows rapidly. People feel wealthier as homes and stocks increase in value. But eventually the system reaches a breaking point. Debt becomes too heavy, borrowers struggle to repay, and the expansion slows. One of the most dramatic modern examples occurred during the 2008 financial crisis. Banks had used the money multiplier to dramatically expand mortgage lending. Housing prices soared for years, creating the illusion of endless prosperity. But when borrowers began defaulting on their loans, the entire structure became unstable. Financial institutions that held trillions of dollars in mortgage-related assets suddenly faced massive losses. Credit markets froze, banks stopped lending, and global markets collapsed. To prevent a complete financial meltdown, central banks activated the second multiplier again. They injected trillions of dollars into the financial system, lowered interest rates to near zero, and encouraged banks to continue lending. The system stabilized, but the underlying structure remained the same. Debt levels continued to rise, and the reliance on money multipliers only deepened. What makes this system so unusual is that most people rarely notice it. Many assume governments simply print money to increase the money supply. In reality, most modern money is created when banks issue loans. Someone takes out a mortgage, new money enters the system. When a business receives a loan, that loan becomes new money circulating in the economy. So the process happens quietly and continuously. The two secret multipliers, fractional banking and central bank reserve expansion, shape nearly every financial outcome we see today. They influence housing markets, stock prices, government budgets, and inflation. They allow small amounts of base money to support vast networks of financial activity, but they also create a system that depends heavily on perpetual growth. Because if borrowing slows significantly, the multiplier slows as well. And when the multiplier slows, economic activity can shrink. This leads to 3 important takeaways. First, most money in the modern world is created through lending, not physical printing. Banks expand deposits through fractional reserves. Second, central banks amplify this process by injecting reserves that increase the banking system's ability to lend. And third, the entire system relies on continuous expansion of credit. Without new loans entering the system, the money supply struggles to grow. These two multipliers quietly shape the global economy in ways most people never realize. They turn small deposits into vast amounts of circulating money. They power growth, finance governments, and support modern living standards. But they also create a delicate balance. A financial system built on expansion cannot remain perfectly stable forever. It must continue growing to maintain itself. And the deeper question is not simply how these multipliers work. The deeper question is what happens if they ever stop working?